everyone, my name is NURUL ASYIQIN SAFYYAH binti Nur Ehsan, and in this video I will present chapter 5 of MGT361, which is about the international monetary system. This system is very important because it helps countries trade and invest with each other. The international monetary system is like the global money rule book. It helps countries exchange currencies fairly and smoothly. This makes trade and invest easier. If countries didn't follow any system, there would be a lot of confusion and risk when doing international business. A long time ago, most countries use the gold standard. That means their paper money could be exchanged for real gold. This made people trust the value of money. The UK started it in 1821 and many followed. Because gold had a fixed value, currencies were also stable, which made trade easier. But the gold standard didn't last forever. After World War I and the Great Depression, countries needed money and started printing more, causing inflation. They also devalued their currencies to make export cheaper. This caused instability and ended the gold system. After World War II, countries met at Bretton Woods in the United States. They created a new system using the US dollar backed by gold. They also formed the World Bank and IMF to help rebuild the stabilized global economy. The World Bank was created to help Europe recover after the war. Today, it supports poor countries by giving loan, technical advice, and invest support. It has 4 smaller agencies like IFC and MIGA that focus on private investment, insurance, and development. The IMF is like the world financial helper. It makes sure exchange rates are stable and help countries face financial trouble. For example, if a country's currency value drops a lot, the IMF can help by giving loan and financial advice. Members of the country pay a quota to the IMF. The more you pay, the more power you have in decision. Countries can borrow more if they have a bigger quota, but sometimes IMF giving loans with condition like cutting spending or changing policy. This is called IMF conditionality. The Bretton Woods system ended in the 1670s. The US dollar became unstable, and people started unchanging their money for gold quickly. In 1671, President Nixon announced that the US will stop converting dollars into gold. After that, countries moved the floating exchange rate, where currency value depends on their market demand. Today, most countries use a flexible exchange rate, but some still manage their currency values slightly. For example, Malaysia pegged the ringgit to the US dollar during ASEAN financial crisis to stabilize the economy. In the 1980s, countries tried to fix exchange rate problem. The Plaza Accords allowed the US dollar to weaken, and the Louvre Accord tried to stabilize it. This agreement shows how countries sometimes need to cooperate on currency issues. There have been several major financial crises in 1970s. Oil price rose suddenly and banks gave rich loan in 1997. Thailand's currency collapsed and the panic spread across Asia, and in 2008 the US housing market crashed, affecting the whole world. To solve the debt crisis, the Baker Plan and Pratt Plan were created. The Baker Plan rationed debts and made countries follow IMF rules. The Pratt Plan actually reduced debt and helped countries buy back their own loan notes. To conclude, the international monetary system is very important for global trade and stability. It started with the gold standard, changed through crisis, and is now flexible system. Institutions like the IMF and World Bank continue to help countries grow and recovery. Thank you for your time. I hope this presentation helped you understanding chapter 5 better. If you have any question, I will be happy to answer them. That's all. Thank you.